I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Big oil, as you say, is drowning in a sea of debt.
Yes. So big oil is, since the price of oil took a leg down in 2014, which of course none of the companies saw coming because they're always optimistic about price. Since then, the major oil companies in the world have actually doubled the amount of debt that they have on the books, and that's just in a 2-year period. And the interesting thing there is that they have done it to continue to pay out dividends. So I say that any small business owner can comprehend that this is a fool's game. When a company spends more than 100% of their profits on dividend payments to shareholders, if a regular business does that, they're certain to go bankrupt eventually. I mean, you can't pay out cash that you should be using to run your operations and declare it profits and give it away kind of thing. And that's what they've been doing. Not only have they spent more than 100% of their profits, but they have borrowed all this money, the record amount of debt they've ever had, to continue to basically prop up their own share value. So this goes back to this whole discussion which we've touched on before about how we're paying CEOs in the wrong way. All the incentives are about trying to goose asset prices on the stock side without managing the balance sheet or the income statement in a responsible way, not investing in R&D, not investing in innovation and operations and, training the workforce and all those things. None of that is on the radar now because the focus and obsession is with this short term, how do we get the share prices up on a quarter after quarter basis. And so at this rate, the only way that the large oil companies can continue paying the dividends that they're paying right now is if, and this is their own guesstimation, they say so long as oil prices stay in the $50 to $55 a barrel area, we should be okay for next year to continue our payouts to shareholders while maintaining current operations. The problem is that, of course, as you know, oil is well under 50, not in the 50 to 55 range, and indeed, if we see a strengthening U.S. dollar, as we may well do in the coming months, and that coupled with a declining global demand picture could be very heavy on oil prices again. And of course, there's no plan B. So they've got all this debt, and the idea was, just borrow now and we'll pay it back later once prices rebound. But if that doesn't happen, I say this is the Kodak business model, hoping things will go back to the good old days when the world's clearly moving on to new energy systems and technologies, and you're just hoping that the good old days come back. So I think it's a pretty irresponsible way to run their business, but they keep they're dinosaurs. They keep obsessing about how to be fossil fuel producers when instead they should be thinking about how to be energy innovators and a broad, diverse portfolio of energy types. So I think we're still quite a bit away from that revelation.
Well, Enbridge did buy part of a wind farm in Europe, so maybe they are looking ahead.
Maybe so, but they have so much sunk costs into their fossil fuel producing operations, and they have all their kind of expertise, chips, and bias on that old school thinking and technology. So they do these fringe kind of things, but I don't think that the directing minds of the businesses and the shareholders, frankly, are actually embracing the future of the new technology and the new energy resources in the way that they should yet. I think they're mostly just, tinkering at the edges to make themselves look good while really doubling down and hoping that the price of oil comes back any day now.
Well, a new thing that's happened called FinApp, where you get secure banking transactions, person to person, company to company, without having to use the big banks. A couple of young fellows have invented this device that's worth $5 billion. That's what they've been offered. And they said, no, we want consumers to be the winners. Is this going to be a new attitude, and are the big banks going to be in trouble because of it?
I think, this is part of the technological innovations that we're seeing across a broad spectrum of business today. It's when I talk about individual passive collection of energy and storage on site and utilizing that to drive our own homes and potentially our vehicles when we plug them in later on with electric cars. When I talk about that, it's a cutting out of middlemen. It's a direct connection between the collection and the consumption without having to pay all these tariffs and fees to the intermediaries. So that has the potential to upend the utility business and the energy business that we are sort of used to dealing with. The same thing applies when we talk about this blockchain technology and this type of direct, peer-to-peer interface. So, if you look at the world economy today, we're staggering under all this debt weight from past consumption, which we did, bought without the actual income to do it, but rather because rates were falling. So now we're at a point where every extra dollar of debt that's added actually diminishes demand and suppresses global GDP rather than, having this miraculous, multiplier impact that everyone was expecting, because as rates fell for 30 years, people could afford more because rates were cheaper, and it looked like rates were driving demand, that low rates were fueling demand. In fact, as it turns out, now we have so much debt that is now going the opposite way. So we knew that point would come, or anyone who was thinking in a logical manner should have known that a point comes where it's not about the rate, it's about the weight of the payments, right? It's the principal itself, that just repaying the principal takes so much of your disposable income that even if rates are zero, your consumption is constrained. So now we're there. So the way in which we have to restructure and revolutionize many of these business models is to lower the cost and drag and finance sort of parasites that take money away from your disposable income. And the finance sector has been a huge weight on the households, business, everything in the world, where they've extracted profits up front, commissions and fees for originating all these sort of financial products. But ultimately, that all is costs up front that are then financed and borne by the consumers. So if you look at this peer-to-peer technology that allows, for example, you think of all these, not just the banks who charge these fees to move money from me to you, but also the, check cashing agencies and places that pay these, to extract these, should be legal rents and rates from the struggling people in the world who have the least amount of money. It's a parasitical influence, and it really diminishes the cash flow we have available for everything else. So these new technologies are literally allowing people to send money from, one phone to, someone working in Canada can send money home to their mom in India from their one phone to another, bypassing banks and intermediaries completely. So no wire fees, none of that stuff. So that obviously is a savings to the consumer. So I say these are important parts of the solution, which is that we need to save more, borrow much less, and pay down debt. And whatever cash flow people have, they have to put some in that pot of savings for future consumption, which everyone stopped doing in the past few years, and they have to really focus on getting out of debt and lowering expenses. So these things are all really exciting ways in which technology can help do that. And the TED Talk I put on the blog this week of Don Tapscott really tries to help explain to people what blockchain technology is and why it is one of those great democracy tools, really, to re-level the playing field, to make people more capable and self-efficient without having to rely on these people who take chunks of their resources. So, there was another interview or segment that was put up by Edward Snowden did this week, talking about how technology, the whistleblower that is now living out his days in Russia on the run from the American authorities. But, the Jill Stein, the Green representative leader running in the American election, has said that Snowden is actually a hero, not a traitor, because he was trying to, again, point out ways in which technology is being used in a negative way against citizens instead of in the supportive way of democracy in which it can be. So all these things are really coming together, and I think people are starting to, of necessity, because they don't have enough cash flow to go around and to waste, so to speak, getting more frugal and efficient. And I think that's ultimately how we get out of this mess, because we know that we can only increase wealth when we increase efficiency and productivity. And productivity has been going down in the world as everyone's been over allocating resources towards things like expensive shelter and cars, right? So if you think about that, our house today is not more valuable to us as a shelter than it was, 20 years ago at a third of the cost. It's still the shelter that we live in. Same with a car. Whether you pay $10,000 or $100,000, it's still just your mode of transport. The only way you can actually increase your wealth is if you're able to sell, for example, a highly priced shelter and buy yourself or rent a more modest abode or something at a lower price in a different area and actually bank excess savings. And that savings produces an income which supplements your spending power for the present and in the future. So that's how you actually store wealth. If you're going to keep it in an asset and it's all on paper and it looks like it's gone up in value, but you never crystallize on that, then all you've got is a very expensive shelter. You don't have any increase in net wealth. So all these things, people are starting to rethink the way we've been conceptualizing what it means to have a good standard of living, what it means to have wealth. And I say, unless it increases your saving and your spending power by making you more efficient, then actually it's not increasing your net wealth.
We'll have more with Danielle Park right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Danielle Park. Danielle, I see the Canadian banks, even though they're exposed to all of this oil debt, have actually reduced the amount of money they have on hand to cover defaults.
Right, and that's how they've boosted their earnings, right? So I saw someone sent me a chart today showing that in the world banking sector since the start of the year, the banking shares of all the major companies, whether they be on the FTSE in London, the DAX in Germany, the Nikkei's Japanese banking sector, the CAC 40, all of them, the S&P even is slightly negative year to date, whereas all those other indices, the banking sector in those countries is really taking it on the chin, with the shares of that sector down anywhere from 50% in London to, down sort of 3 or 4% in the S&P in the U.S., and the banking sector in the world that is still up year to date in terms of share performance is the Canadian banking sector. And I think that is truly ironic because, there's this mythology that Canadian banks have always been so much more conservative and so much better capital ratios and so much less risky than other banking groups in the world. The fact is, however, that because our housing bubble has not yet deflated, because we have not yet had to reprice many of the assets which are, extremely overvalued, and therefore write down the loans that have billowed with them, because we know that once there's a correction in asset prices, the loans stay put at the same value even though defaults rise and the quality of those assets has to be written down. So ironically, Canadian banks have been, kicking the can up the street through this period as Canadians borrowed their brains out and diminished their, as I say, net wealth and financial strength. Their capacity to spend has come down because they've been servicing these massive loans they've taken out and they're paying things like higher taxes and higher utilities and maintenance. Like they're left with a lot less income to go around because of this asset bubble that we've been in the last sort of 15 years. Anyways, so the Canadian banks, how do they respond to goose their performance? They instead of increasing their reserves for bad debt potential, they pretend as if there isn't much risk to all those factors that we've just talked about. Now, interestingly, they've also been pulling back from the oil and gas sector, because the oil and gas sector, as we just talked at the beginning, has really high debt levels relative to even just a couple of years ago, and the defaults have risen. It's interesting that the commercial default rates, delinquency loans, and that sort of thing are already back nearly at the highs of 2008, Jim, and yet you're hearing almost nothing of that. That's in the American corporate sector. You're seeing this increase in delinquencies on loan payments, and the same thing is happening, in the energy patch, and is going to spread, as I say, to other sectors of the economy. So what you should really be doing is increasing your reserves for this coming wave of defaults and bad debts. Instead, they've been reducing their reserves to boost up their earnings in the short run, all back to this same obsession that we have today, where CEOs are all about getting the share price up and increasing the dividend to the shareholders. And, the business be damned, the employees be damned, the stability of the system be damned. It's all about getting the quarterly numbers up. So they do these self-destructive things to make you look like a hero for a short period of time. But the reality is that these banks are multinationals. They're highly integrated. Their operations are very have great impact on one another. Deutsche Bank, for example, is a very significant institution in the world banking culture and sort of infrastructure. And its share price, Jim, is going the way of Lehman shares. If you look at a chart of the Deutsche Bank shares relative to the Lehman shares and the collapse into 2008, Deutsche Bank is coming down almost lockstep in a pattern that looks. And Lehman was a systemically critical institution, as we learned in retrospect, and I think Deutsche Bank is as well. They have huge. They're the other side of enormous amounts of derivative contracts in the world. You think about, again, going back to how do we get into this mess? Overconfidence, too much spending, too much borrowing, too much leverage, right? This is what happened through the American housing bubble into 2005-06, and the burst and the repercussions that came after that. It's what happened in China, which is now in the midst of a massive burst in their credit bubble and housing markets and all that sort of thing. And it's the same thing that happened in Germany as the exporter to the world, and low rates and the consumption patterns were fueling their exports, and they were building up their savings, and they were getting overly confident, and their bank became over-levered as well. So as we see the different pockets of this bubble bursting around the world, you're getting a revelation that these institutions are full of risky loans and risky connections in derivatives. So it's, I think we have to keep a really close watch on things like a major institution like that and the knockoff effect it could have into the finance sector. And I think that's why many of these indices in the world are already selling off. And it's why I think the Canadian sector stands out like a sore thumb, not for its brilliance, but rather for its lag in what I think is going to be a pretty painful repricing in this credit cycle.
Is one of the reasons why Donald Trump is so popular is the fact he wants the big banks broken up and would bring back Glass-Steagall?
He does say that, and I have pointed that out recently, that I think, I think truthfully Bernie Sanders is the one who, in his discussions and campaigning, brought that issue to the center of both political parties. I don't think either political party wanted or had much interest in bringing that promise to the fore, but I think they were shamed into it, both by growing repugnance of the banking sector and this falling faith in the Fed and these monetary magicians. I think that there's a huge amount of the population that's just fed up for good reason. Fed up is literally a movement out there, in other words, sick of the Federal Reserve. It's like the the Occupy Wall Street movement that was prevalent after the last recession. Anyway, so all that is kind of swirling around out there, and I think both parties, Hillary Clinton said something to the effect she's had to tip her hat to looking at ways to break up the banks. I don't think either party knows or really has an interest in doing it. I think Trump is saying that because it's a popular message, but at the same time he's saying he would gut Dodd-Frank, he would repeal all the laws, he would take away all the regulations. Like, less regulation in the financial sector is not what we need. What we need is more meaningful regulation. So, I don't have much faith in anything he says. I think he's just saying whatever he thinks is going to appease the masses at this point. But it would be, I think it is a critical piece. I've talked about that before. We don't need more complexity. We need more meaningful divisions and hard returns. We have a world of corporations and executives who are literally on the take, far and wide, across all sectors. It seems like it's just run completely out of control, and people have very skeptical and deservedly so takes on, the leadership that we're seeing at all levels, from regulation, from governments, from prosecutions, from corporations. They're really quite literally out of control, and finance is, of course, one of the leading sectors of that. So I think it's important that we get some ethical hard returns in place that say people can't, double dip, triple dip, suck and blow, sell and advise, all these things they've been doing that have really caused great financial harm. And we'll see. We'll see. I think myself that until we get a financial sort of meltdown again, you're not going to see any meaningful restructuring from anyone in government. I think right now you've got this, you've had this standoff for a number of years between the far right and the far left. There's very little moderate discussion and practical steps taken in the middle. I think that the financial credit bubble enabled that kind of extreme positioning, as I've said before. As long as you've got a line of credit to throw things on, you can sort of give everyone what they want without having to have consensus. That's what we did for a long time. But I think now that we're at the end of the lines of credit, we're well past total debt levels that are in any way workable. The Federal Reserve's already at zero. They're meeting in Jackson Hole this week. I call them the Fed gazers, like navel gazers, are all waiting for the next speech from Janet Yellen. The truth is, as the Wall Street Journal has literally come out today and said, years of Fed missteps have actually fueled this whole mess by thinking they were in control, that by having great hubris, by believing that you could constantly push consumption by pushing down on rates and increasing liquidity. They really drove us right off the cliff. And politicians took credit for all that, what looked like growth, which was really just reaching into the future, pulling forward consumption and spending it in the present, and leaving big holes in the future. Well, we're in the future now. We're falling into those holes. And, everyone's sort of looking around surprised, wondering how this could have happened and who they can blame. Increasingly, the Fed is being targeted, and it's quite a populist movement across many even, academics and people that were previously big Fed supporters are coming out and saying, wow, this is a mess, and, these policies are largely responsible for how we got here. So, we'll see. I think we're at the end of monetary policy that's in any way reasonable. And let's not forget that the monetary policy people, the central banks of the world, have already tripled the global supply of money in just the last 8 years. So they've tripled the global supply of money in the last 8 years through these various, adding ones and zeros to the system, basically fabricating money, moving it around, buying back assets and moving zeros and ones from one balance sheet to the other. They've increased our leverage that much, but they haven't increased anything of value in the world. They've just made these assets that much more expensive. So if you look at that, once that revelation is sort of broad-based and you start to see assets come back down as they are wont to do because tides can't keep them up forever, I think that's when you're likely to get the next wave or push or insistence for something meaningful in terms of structural reform, and we definitely need lots of structural reform, but it's going to involve breaking up the oligarchies and the status quo that's trying to keep everything the way it is, and the rent seekers and the people that are trying to extract funds all over, and getting back to a meaner, leaner system, which is, much more careful about how dollars are spent and how budgets are balanced, because, you can't keep adding money to this line of credit. Hoisington Review just came out with a great quarterly note showing that at this point, because debt levels are so high, for every dollar of deficit spending from the federal government in the United States, you're losing a cent of GDP. So this miraculous, in the past, you used to spend $1 and get $4 of upside in the economy because you had this reverberation or money multiplier effect. Today, it's the opposite. Because there's so much debt, every time we issue more debt to spend something on deficits through a government agency, you end up hurting, detracting from private GDP. So we can't continue to do this anymore. And I think that's, a good thing in the end, because it was always a very destructive approach. And so now we'll have to get, I think, a big distortion in financial markets again before you get any political will to realize they can't keep adding to the line of credit, and now they have to get down to negotiating something. So ultimately, I think the extreme positions will be thrown out. The politicians who can't do anything meaningful will be disdained, and it'll be the people who can roll up their sleeves, work within budgets, and actually be efficient with capital that'll come out as the heroes in the end of this episode.
Danielle, thank you so much for chatting with us.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. You can check us out on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.